Hi guys, and welcome to this beginner's guide to technical chart analysis. So in this video we will run through the basics of how to perform chart and trend analysis. In order to do that, we will run through the historical charts for Tesla. I'll also talk you through some of the most common trends and charts that I use in my analysis of growth companies in particular. Now, one point of context is that fundamental analysis of a company and its results always trumps technical chart analysis. So even if all indicators point to a certain trend, it might not actually happen. Don't treat this as investment advice, just some pointers for you to get started on some basic trend analysis. And at the end of the video, I'll put out all the patterns on a single page, so it's a cheat sheet for you. Before we get started, please do consider subscribing or liking this video, as it helps get the channel out to more people. Thanks. Now, there's a lot of money that is to be made in stocks, and there is absolutely no doubt that is a great way to financial freedom and early retirement. But analyzing companies is a very important discipline in investing. That just goes without saying. However, by the time you've understood the business, digested news about it, it's often too late to react on short-term trends, and the stock price is already moved. Now, that wouldn't matter if you're a long-term investor. But for a short-term trader, it just does not work. So then how are these day traders making a killing? Well, that's where technical chart analysis comes in. So what is it? Well, a lot of it is looking at patterns by analyzing statistical data gathered from trading activity. So those patterns may indicate when money is likely to go into a stock or when money is likely to get out of a stock, hence driving movement. Now, in reality, these days, it's all algos. So these are essentially computer programs that are sitting in computers of investment banks and hedge fund managers, continuously scanning for patterns and indicators of movement and trade. Then in milliseconds, they're executing thousands of trades to bag a neat little profit. So what that means to an average retail investor like you and me is that the reliability of these patterns have now reduced. Actual movements might not follow the pattern as a result. Nevertheless, they can be a powerful tool to make an educated guess on how the market might move. So let's get started. First, the absolute basics. Candlestick patterns. Now, you need to understand candlestick patterns to understand any of this. A candlestick pattern shows the market's open, high, low, and close prices. If a close price is higher than the open price, it's a bullish pattern. If the close price is lower than the open price, it's a bearish pattern. So bear that in mind. Next up is an uptrend. An uptrend is where if you were to draw a line between a group of candlesticks, it would show both low prices and high prices increasing over time. So that's a higher high and a higher low. And as you can see from this pattern in here, the highs are getting higher and the lows are also getting higher. So higher highs and higher lows. A downtrend is exactly the opposite. Now we're getting both lower highs and lower lows. So essentially, we have both the highs and lows reducing over time. Lower highs and lower lows. Lower highs and lower lows. The third basic indicator that you need to think about is the moving average. So what this does is that it takes the average stock price over a certain period in time and then plots that as a line, essentially the continuous average over time. So if, for example, you're looking at a 20-day moving average, the average stock price over a 20-day period is calculated and it's plotted continuously. Likewise, a 50-day moving average is the average price over a 50-day period. Personally, I use the 20, 50, and 200-day moving average. So the 20 or 50-day moving average for short-term trends and the 200-day moving average for long-term trends. Now, where it starts to get interesting is when that line, that moving average line, crosses the candles. That might be an indicator of a trend change. So in this example, where my moving average line crosses the candles, I expect my uptrend to now change to a downtrend. And that change in trend swiftly follows. Once again, my trend line crosses my candlestick, and now I expect my downtrend to change into an uptrend. With those basics out of the way, let's look at my top 5 chart patterns to get you started on your technical chart analysis. Number 1, and my favorite, support and resistance lines. These lines refer to levels that act as barriers to prices going up or down. A support level will indicate prices at which there is enough buying support, so a downtrend will not fall below that level. A resistance level indicates prices at which there's enough selling pressure so that an uptrend will be stopped at that level. So it's exactly the opposite. The timing of your trade is based on the expectation that a support or resistance zone will not be broken. So you buy when the price hits the support line, and you sell when it hits the resistance line. Drawing these lines is more art than science. You identify multiple historic price levels where there's been an uptrend or a downtrend reversed, and you draw a line through the top or bottom of those points. The more price levels that touch that line, the stronger the support or resistance level. Once a resistance level has been broken, it might start to bounce around to a new support and resistance line. And you essentially are then repeating your analysis again. So these lines don't need to be horizontal lines. You can sometimes use a 50 or 200-day moving average line as well to work out where that support and resistance level might be. So let's take this Tesla example from 2017 to 2019. Here we see a support line form around $51. On 3 or 4 instances, as soon as the price goes down to this level, there's a buying pressure, which pushes the price upwards. There's also a very strong resistance line at around $71, $72, where the price seems to hit a ceiling a number of times. At this point, there's enough selling pressure that the price doesn't break out of this level. We see a few attempts that the stock makes to break out of this level, but in all of those instances, it falls back. Finally, after a good couple of years, in October, we finally see a break, and we see that $71 resistance line being breached, and it shoots up to over $180. Now what usually happens is that the longer the box pattern that we've seen is maintained between the support and resistance line, the bigger the breakout that's expected. So in this period, we've had multiple years of stock price staying between $50 and $70. So when a breakout finally happens, it is incredibly strong. We also see that $71 resistance line turn into a new support line. And this is where we had the maximum force of the pandemic hit the stock market back in March 2020. And this $71 line is seen as a new buying opportunity below which the stock price does not dip. A similar pattern is observed at different levels over time. So $186 is where we start to see some resistance that then turns into a support line. $460 odd is again where we see some strong resistance with multiple candlesticks hitting those price points. Again, at around $600, at $700, at $885, all of which are support and resistance level. So if I was looking at the Tesla stock chart, I'd say there is a resistance line at $885. So in the short term, that might be a selling point unless there is a breakout above that level. If the price falls, $700 to $720 is the next level of support or resistance if it has been tested multiple times. If the price falls below that, you're now looking at about $560 to $600 to act as the support and resistance lines. And if it falls below that, then there's a strong resistance at around $460, which might become our new support line. Next up, at number 2, are our wedges and triangles. Now, wedges are essentially 2 converging trend lines that act as support and resistance levels. The ones that are shown here are symmetrical wedges. This is an indicator of a continuance in trend. So if we were in an uptrend before we got into that wedge pattern, we will likely continue in that uptrend after we get out of the wedge. Likewise, if we were in a downtrend before we got into a symmetrical wedge, we are probably heading to a downtrend after we get out of the wedge pattern. The longer it takes for the wedge to form, the more explosive the breakout is expected to be. So if you were to calculate a price target, one idea could be to look at the difference between the highest and the lowest point in your wedge, and then add that difference to the breakout point. That is the place where you sell your stock. Staying on wedges, you might also see a rising wedge and a falling wedge pattern. So a rising wedge is an indicator of a bearish pattern, so a price is likely to go down. At the first instance, it looks like a bullish pattern being formed, where we have higher highs and higher lows. But then what is interesting is that the upwards movement is getting shorter each time, indicating that the bears are starting to take over. So this negative sentiment builds up so that when the market moves beyond its rising support line, anyone with a long position might rush to close their trade and limit their losses. So those waiting to short the market, meanwhile, they will jump in. And this causes a tide of selling that leads to a significant downward momentum. A falling wedge, on the other hand, is the exact opposite and an indicator of a bullish pattern. So the price will likely go up. This time, the downwards movements are getting shorter and shorter each time, indicating that bullish opinion is forming. The third type that I want to highlight are the ascending and descending triangles. Now, a descending triangle is an indicator of a bearish pattern. The lower trend line is horizontal and the upper trend line declines towards the apex. This means that there are a declining number of bulls in the market to push prices up until the bears eventually take over the stock and push the stock into a downward spiral. The lower horizontal trend line, which is acting as a support line, now becomes the new resistance line. The ascending triangle, on the other hand, is a bullish pattern. This time the upper trend line is horizontal and the lower trend line is rising towards the apex. So what we're seeing here now are higher lows as buyers are patiently stepping up their bids until a breakout eventually happens. The upper horizontal, now which was acting as a resistance line, now becomes our new support line. Here are some of those patterns in action for the Tesla stock. We can see a wedge appear and trading volumes decline. People are essentially waiting and watching until we finally see a breakout on the 17th of November when the price jumps over to $440. That's after nearly 3 months of consolidation. Now, as a trader, you would look at the maximum width of the triangle. So that's $500 minus $320, which makes it about $180. So that's $180 to our $440 breakout. So that's a price target of around $620. And that's what we see actually happen. So the immediate breakout goes all the way up to $600, where we see the emergence of a new support line. It just so happens, if you look at the trading volumes, that big money stepped in around then. So that must have been like a hedge fund or an institutional investor who seemed to have entered the picture right about in the middle of December 2020. And the stock heads off on yet another major bull run to about $900. Here's an ascending wedge in action from some time back, and as you would guess it, goes into a bearish pattern and the price falls around 20%. This time a descending wedge where as soon as the breakout happens, price shoots up to around $50 a share. An ascending triangle, which indicates a bullish pattern being formed over a 3-month period. And then when that is breached, it leads to a rapid gain in the share price. A more recent descending triangle, and as you'll guess it, price drop swiftly follows once the breakout has happened. On to a third pattern, and this is the heads and shoulders pattern. Now this is where we have a baseline, which is also called a neckline, and 3 peaks or 3 troughs. The outside two peaks are close in height, and the middle one is the biggest. The neckline acts as a level of support or resistance. Now, when you see a heads and shoulder formation happen, it's usually a bearish pattern, indicating that the price is going to go down. On the other hand, an inverted head and shoulder pattern indicates that a bullish pattern will likely ensue. So the most common entry point in such a pattern is when the breakout happens from the neckline. Here's an example of a bearish heads and shoulder pattern from the Tesla stock chart. The breakout happens on the 23rd of October after the pattern has been formed. So our entry point would be that for a short trade. And the price falls well over 10% over the course of the next week. On to number 4 on our list, and that's the cup and handle pattern. So this is where the cup looks like a U shape and the handle has a slightly downward drift to it. Generally, cups with a longer and a more U-shaped bottom provides a stronger signal. The challenge, however, is that it may take a long time for this to form, and then by that time you are probably too late to act on that trade. An inverted cup and handle, on the other hand, is an indicator of a bearish pattern. Here's an example from the Tesla stock chart. A slightly more V shape than a U shape, but nevertheless an indicator of that pattern. And as we see, it leads to a nice little uptrend once the breakout happens in April 2020. Finally, at number 5 are the double tops, like the letter M, as shown here, or the double bottoms, like the letter W. These are all indicators of a reversal in trend. So an uptrend is going to become a downtrend after getting into the pattern, and a downtrend will become an uptrend after getting out of the pattern. These patterns are a little hard to identify, I have to admit, and I often find the volume indicator to be helpful here. So with a double top, the prices reaches the first peak on an increased volume and then falls down a valley with a lower volume. So another attempt on the rally up to the second peak should typically be at a lower volume and then exiting out of the pattern with lower volume as well. Here we see the double bottom with the Tesla stock, which is an indicator of a trend reversal. And we see that play out as the prices go up. And there we have it, a summary of all of the charts and patterns and trends that I've talked about in this video. One final piece of advice: when you're looking at patterns, make sure you look at the volume as well. It's a good indicator of what the sentiment around the stock is, which can help actually analyze the patterns a little bit better. So the ones that I use the most, especially when it comes to heavily traded stocks like Tesla, are the support and resistance lines, as well as the wedges and triangles. Well, I hope you found the video interesting and you've learned something new about trading using technical analysis. If you did, please do consider subscribing and smashing that like button, and do leave a comment below. Thanks again for watching this video.